Chapter 2, Managerial Economics, talks about the firm, its goals, and the chapter outline talks about the firm and the resource allocation. And the main point for Chapter 2 talks about the importance of allocating resources. Because remember, in economics, we talk about resources. And we're talking about profit.
Can you also say, because there's a question in 3 that says, why should...
And it talks about profit maximization, the economic goal of a firm. And we talked about the importance of profit maximization as a concept because it kind of drives the behavior. Because if you remember, consumers, they always try to maximize their own profit, right? Or they maximize their own value, or they maximize their own satisfaction. And then for producers, they also try to maximize their profit. So the profit maximization as an important concept, as an economic goal for firms, and goals other than profit. So we'll talk about, is profit always the main goal for companies? No. In the pure capitalist world, they go after profits only. However, now it is more realized that it's not just profits that maximizes your wealth. Maybe there are other considerations, so we'll talk more about that. And do companies maximize profits? Is this yes or no? So we'll take some of the measures, and we'll talk about maximizing the wealth of stockholders. Now, you guys understand the idea of stockholders and managers. There is an important, it's an important discussion that in many of the corporates that we talk about in business in general, we always differentiate between managers and owners. Sometimes, many companies, maybe you know, maybe companies you work for, the manager is the owner. So, and in many cases, we see this. But when we look at the study of management, finance, economics, we always try to differentiate. If you remember in your accounting classes, maybe they had to differentiate between the owners and the stockholders, and the owners withdraws, and the owners. And here we have to understand that there is a difference between the manager and the owner. What's the difference between a manager and an owner? The owner will be the stockholder, and these people, they have the money, and they invest in a company. And then this company will have a manager, and the manager's job is to manage this business. If they are the same person, then the same person will look to maximize their own profit, and at the same time maximize the business profit generation. But it's not always the case. Therefore, we try to put this distinction between owners and managers.
Can we put it in this way? Can we say...
So, as you can see, because we separated the owner from the manager, as a consequence, we start to see this agency theory, or the agency problem. And that's because we start to have the owners, they want to get the maximum return on their investment, and managers, they want to get the maximum benefit for themselves. Now, sometimes the managers, they have, let's say, bonuses in case the company achieves this good results. Therefore, they're more after the bonuses than they are after the overall wealth of the company. And vice versa. Sometimes investors, they are more after the return, so they may not be after all of the control elements that may happen inside the company. So this becomes an important area for understanding. And if you see here in Yemen, we've got this problem on its not very clear, direct image. We see here a lot of companies now, they go after corporate governance. Anyone have heard of corporate governance? Okay. Maybe some of you have been members in the Yemen, you guys know the Yemen Business Club?
Yes.
Now, in the Yemen Business Club, they do a lot of training for corporate governance. A lot of international organizations, they help in this governance. And the idea with governance is when you hire someone on the board of directors inside the company, these people, they need to have a good understanding of their job as a board member in terms of understanding the owners, understanding the management, how the operation should and should not be. And then we've got this idea of economic profit. Do you guys remember the differences between accounting profit and economic profit? How many people still confuse the difference between these two? Great. So here we're talking about the economic profit. The economic profit mean the main issue with economic profit is the idea of this implicit profits, right? The costs that are not directly measured. We talked about examples of an economic profit. We said, if you have, if you're going to work for 1 hour, and this 1 hour you will work, let's say you're a tailor, 1 hour you work, you have this whatever product you make, you sell it for 1,000. Now, how much is your profit? 1,000. If you go to the accountant, they say, okay, you worked 1 hour and you generated 1,000. That's your accounting profit. However, from an economic perspective, and you look at the economic profit, in 1 hour you could have worked somewhere else, and maybe you got, because the minimum wage out there is 500. So really your profit is only 500 riyal, because the other 500 riyal you could have gotten it because you spent 1 hour of your time, and that 1 hour of time you could have actually worked something else and you could have got 500. So the real economic profit that you generated during this 1 hour is not that 1,000. It's just the 500.
So is it equal to the opportunity cost?
So basically it's how much money you make deducting anything that is implicit, anything that is opportunity cost, anything that is indirect. If you took, let's say, a risk, that risk that you took, you need to compensate for it. So that's the idea of an economic profit. So learning objectives, we will understand the reasons for the existence of firms, the meaning of transaction cost. Do you guys remember transaction cost? Transaction cost, it means everything that will cost you for this business in order to make this transaction happen. Explaining the economic goals of a firm, optimal decision making. Do you guys remember the word optimal? We said it's the key word for an MBA. And describing the principal agent problem. We talked about the principal agent problem, which is once you have a manager and an owner, they have conflict of interest. They don't always have the same objective. Anyone have ever hired an agent? Remember Al-Muwakkil Nusra Jah? Goes under this principal agent. You see that once you start to delegate, then there is some sort of a cost associated with it. You start to have some sort of a conflict. It comes around the same problem. Distinguish between profit maximization and maximization of the wealth of the shareholder. So there's a difference between how much profit you make as a business, as a company, and how much money you make as a shareholder. Shareholders will be the stockholders, the people who actually own stocks of the business. You see, shareholder is the same as a stockholder. Now, stockholders is when the company is publicly traded and it has stocks, and then maybe if it's a limited liability and you have partners, then they will be called the shareholders.
Sometimes government is considered as a stockholder.
There is a stakeholder. You guys remember stakeholder? Stakeholders, which will mean customers, government, suppliers, employees. Stakeholders, everyone who has a stake inside the company. And then we will look at the MVA and EVA. Which of these topics you think we have to make sure we cover well? Raise your hand. Okay, any particular topic you would like us to go over more? So we've got here the firm, collection of resources that is transferred into a product demanded by consumers. So any firm, you will take resources, you make products. You guys remember you have a land, you have water, labor, you got some seeds, you have some contractors or machinery, and then you can grow tomatoes. Profit is the difference between revenues received and costs. This makes sense, right? And you take the price, you multiply it by how many units. So if you produce 1,000 kilos, every kilo is for 1,000 riyal. Here you get your revenues. You deduct your costs, all the salaries you had to pay, all of the rent you had to pay for trucks. If you borrowed money, you have to pay its interest. If you have, people, you have to pay their salaries, and you get your profits. Why does a firm perform certain functions internally and others through the market? That's when we have the transaction costs. They're incurred when entering into any contract. Every time you have a contract, remember, if you take this, tomatoes, you sell it, you go into a contract. I will provide you with this, and you will provide me with that, cash or money, and that would be a transaction. And then we can look at types of transactions. We've got some of the investigation. Remember, if you're going, someone is going to buy something from you. If someone's going to come and buy my potatoes, then this person will probably have to investigate my potatoes. They may take some potatoes, send them for testing. They may have to check my history, check that I'm reliable, maybe ask customers what do they think of my potatoes. That becomes part of the transaction cost, isn't it? Now that becomes part of the economic transaction. Remember, the economic cost become an economic cost. So you need to take that into consideration. If I had to do any negotiation, that's also part of the transaction cost. And if in case of the contract is not enforced, you also have to pay for enforcing the contract. So that also becomes part of the transaction cost. And everything that goes along, if you consider everything, you go, you shop, you go, you have to shop, you have to spend some time, some money, some effort, you choose, you check, you validate, and then after you buy, maybe, you're going to give up on, on the contract, or you may go into a legal perspective, you may have to bring the product back and have it fixed, and so on. So all of that will be part of the transaction cost. Enforcing contracts may mean going into court, going for arbitration. Maybe it includes bringing experts to make an expert decision. So maybe you go and you check it back. You go back to the so whatever it takes to make sure that the contract is going. Maybe inside your company you have an internal audit. Maybe you have some accounting people who have to check. You have to pay for them. All of that in order part of the enforcing contract. Okay. The firm transaction cost incurred when entering into a contract, it influences, there is an uncertainty influence. If you are uncertain about this transaction, you will have to increase your certainty, and that will require some work. Frequency of reoccurrence. So how much, if you always come back and buy from me tomatoes, then after a while, maybe the transaction cost will drop. And also, if there is an asset specificity, and that's when, if you already know that the equipment I use, is some sort of a standard, then here it becomes maybe lower transaction cost. Okay? Examples of transaction costs. Yeah, the examples of offshoring to source consumer products, like retail stores. They go to China to produce their manufacturing components overseas. The automotive industry, they now are completely international. You cannot know where this company is really from. You buy this whatever product, and then 15% comes from. Do you guys know how much of the iPhone is made go back to the Chinese economy? 5%. Because the iPhone, the camera, it comes from Germany, and the processor come from Japan, and then this special machine come from Korea, and this special piece comes from this other country, and only 5% really goes to China, even though it's, that's where its final assembly was. So you need to, consider that, the transaction cost to get all of this, to work together. That's another cost. So for Apple to increase their prices, they need to cover all of their transaction costs. Not to talk about, they need to do a lot of research and development in order to make sure that their products can come up. And logistics services, any warehousing and delivery, that's also another cost. Did you guys hear about those drop shippers? There are companies now, their job is drop shippers. So they work on, they do the sales, but they don't touch warehouses, and they don't do any delivery. Because these are activities, they outsource it. So DHL take all of the delivery, and some other companies will do the warehousing, and they just don't have to worry about that. Do you guys remember the case study for what was it? Toshiba.
What is that?
Yeah, the Toshiba case study says, if you're a customer of Toshiba and you call them and you tell them my laptop I just bought is not working, they tell you, okay, we will send you the email, you print the paper, you take the paper to FedEx, FedEx will take the laptop, ship it, to be fixed, and then after 1 week you get back your laptop. Now, of course, what FedEx do is FedEx, they take this laptop, and inside FedEx facility, they actually get all of the laptops, and they fix them there, inside FedEx company. They have the engineers there. They are signed a contract with Toshiba. No, they wherever location. Maybe it's the same country, maybe it's a different country. And they do all of the fixing, and then they do the shipping back. And it does not touch Toshiba hands at all. Because this is fully outsourced to FedEx. They do the delivery, warehousing, fixing, engineering, returning back. And next, we've got here the limits to firm size. Here, we're talking about trade-off between the external transactions and the cost of internal operations. So here, imagine if Toshiba, they want to do it internally, right? So internal operations here is percentage. So maybe they can do 0%, or they can do 100% internal operations, okay? And then we can look at here at the cost, right? So in case of a zero internal operation, so they let FedEx do all the job, it become 100% maybe cost that they can measure and value, you see? This way they know it for sure. This is how much money they have to pay that goes directly to FedEx in this example. Or maybe they can do 200% internal, and in that case, they have to do 100%, their operation. Do you see? So between those two extremes, we have those lines. And those lines kind of show you, how it will accelerate over time. And we can see that if you add those two up, so if they decided to do 50-50, so maybe they will, because remember, if you have a problem with your laptop, you call them, you have to report what is your problem. And then they will make a decision, basically where it will go and what engineer will have to see it, and whether it is under warranty or not, and is it something that is they cover or not. So there is some sort of an internal operation there to happen. But if they do it like 50-50, now in here we can get this minimum. So maybe what you're saying, Ali, is that they need to consider this more and see if this minimum area, it can do better for the overall return for the company. So here comes the company, they have to choose to allocate resources. So their total cost is minimized, which includes also any uncertainty or customer dissatisfaction for a given level of output. And of course, depending on their level of output, so how many actually, they produce, how many customers they have, will be another factor. And then outsourcing of peripheral non-core activities. And we also have the idea is, maybe for Toshiba, that's not their core, is to fix. You see, their core is maybe just to make. Now, if there's something wrong because of any reason, then maybe that's not their core, so they are not going to be very focused on it. Reshoring is when they come back. So operations, they are returning a company where the offshoring occurred. So the example is the USA, and we talked also in the other class about, there are some maybe rules and regulations that may bring back some of the jobs that used to be exported to Yemen. We talked about like Ma'waz business. Signs of reshoring: wages in developing countries, they have begun rising. Decrease in the value of the dollar has increased the cost of importing. Increase in the energy cost made it more expensive to ship products. And then manufacturing firms have significantly increased productivity, making firms' production more competitive. Which one of these you think is very close to Yemen? Number what? Number two. Yeah. See, number two, the decrease in the value of the dollar They have increased the cost of importing. So for Yemen, the decrease of the value of the Yemeni area it becomes a reason, instead of you import, make it locally. You see, so it's there's more needing for local production because you can no longer import, become very expensive.
The reality is still they still import.
Yeah, they still import, but at the same time, maybe because it's become very expensive. So if you do it locally, it will be cheaper. And then here it talks about profit maximization hypothesis. What is the hypothesis? Primary objective of a firm to economists is to maximize profit. Other goals may include market share. Because remember, sometimes you just want to get a high market share because once you have a market share, then customers will believe all of the marketing theories behind getting customer market share. Revenue growth. Sometimes you just want to have the cash, the revenues. Maybe you have a shareholder value. It's that's your main objective. Optimal decisions is the one that will bring the firm closer to its goals. Critical to be precisely aware of the firm's goal. Different goals can lead to very different managerial decisions given the same limited amount of resources. So here we're talking about how to get the optimal decision. Do you guys remember in your did you take any optimization cases in one of the other classes, maybe in your MIS class, or where you actually, how can you use decision science, how can you use statistics, and we'll talk more about that in chapter 5, in order to get that best decision that is going to reach your goal. Okay? Yes?
Before we move forward,
So here, some of the other goals, we've got economic financial objectives. They want market share, growth rate. Do you guys know what are these? Do you know what is market share?
Yes.
So how many people are selling, how much is the market size, and how much is your share as a business? What is the market share for Pepsi?
Pepsi.
50% maybe? Okay. Profit margins. We're talking about how much you make profit per unit that you sell. And return on investment, how much money profit you get on every dollar you invest. Return on assets, how much every $1 you have in your assets, in your inventory, how much money you make on that. Technological advancement, what are maybe you want to be the number one in technology, or maybe you want to be the first to market when it comes to technology. Customer satisfaction. Do you guys know how to measure customer satisfaction? How much customers are happy? How much customers are coming back? How much customers say good things about you? And then shareholder value. How much is the shareholder value? How much is their stock maybe? How much dividends you pay them?
This is the market value.
No, this is shareholder value. We're talking about the shareholder themselves. Sometimes the company, they can give shareholders, maybe you want to give them very good value now, maybe very good value in the future. Maybe you want to give them very high profit, very good capital gain, very good dividends. So all of these can be goals. How do you calculate? You can see all of the finance measures. How much is, let's say, dividend per stock? How much capital gain per stock? How much, sometimes there are some other theories in finance that talks about some customers, some stockholders, they want monthly dividend. Some, they want, when they retire, this is going to be their retirement. So there are different value generation or goals for companies. We also have some non-economic objectives: good work environment for employees, quality product, services for customers, good corporate citizenship, social responsibility. All of these are clear. You guys are okay with these? We got here argument against companies not maximizing profit, but instead they merely aim to satisfy, which means firms, they seek to achieve a satisfactory goal, one that may not require the firm to do its best. So here is the argument, should companies maximize their profits, or maybe there are some other things that they need to take care of. And where do you guys stand? How many people think companies, their number one there is to generate money for their stockholders? Okay. How many people say companies, they should not maximize the profit, rather they should maximize the social value? Okay, how much people in the society will gain from this company at the end?
Not in here.
Anyone? Okay.
This for non-profit organization.
Maybe non-profit organization. Okay.
Depends on the
In a
situation.
balanced way.
In a balanced way. Yeah, balance is always becomes an important.
Because there's no such
What
thing
is the
as balance
situation?
in profits.
Okay.
Because I'm making my money.
We should ask what is the current situation of the company.
Okay.
If it's problems. I think it depends on how much.
Should companies focus on the stockholder, or management should consider the company as a whole? Which one is more important, the company welfare or the stockholder welfare?
Company will
How many people say company welfare is more important? How many people say no, stockholders should be more important? Okay. Because remember, at the end, the stockholders, they paid the money.
Yes.
You see, it's the money of the, all of the company, it's, goes back to the stockholders. So the stockholder profit should be maximized.
They will not
And the
invest again.
company, whatever, value they generate, if it doesn't translate to shareholders, then where will it translate? To management welfare? So that becomes another issue. Go ahead, Mira. As you can see, those two forces, we start to, if you look at the stockholders, the position and power of the stockholders, reasons for satisfying by companies, large firms are owned by thousands of shareholders. So many of these companies, if they are big, they have a lot of shareholders, and you need to satisfy all of these shareholders. Stockholders will generally own only minute interests in the firm, and they hold diversified holdings in many other firms. So sometimes for the stockholders, they just want to see the return, and they don't really care about one company. Rather, they have small money in many different companies. So their view of how the company looks like is a little bit different, but that's their position and their power. The power of stockholders. Stockholders are concerned with the performance of their entire portfolio, not just individual stocks. Stockholders are much less informed about the firm than the management. So this is the picture of the stockholders. Stockholders are not likely to take any action if earning a satisfactory return. So if they're satisfactory, okay, they just move on. They don't need anything that's... So that's that's one perspective. Now, if you look at the position of management, high-level managers may own very little of the firm's stock. They may own, okay? So they become a stockholders. Managers tend to be more conservative. They are very risk-averse than stockholders would be, because their jobs will most likely be safer if they turn a competent and steady, if unspectacular performance. So if you think about it, the managers, they always want to have a steady work. They want life to continue. They risk averse, and sometimes they have some stock, so they are part of the stockholders. So the other point here, managers may be more interested in maximizing their own income and perks. So we talked last class about banks in New York when the bubble burst in 2008, and then the managers, they did not want to lower their bonuses, do you see, because they wanted to keep their high bonuses even though the banks are almost falling. So management incentives may be misaligned, revenue goals for compensation and not profits. And this can lead to the divergence of objectives, which is the principal agent problem. Okay, so do you see how sometimes the two objectives may diverge. Stockholders, they want satisfactory, while managers, they want to keep their bonuses.
Because I guess they don't expect the best outcome.
Yeah, in this case, next we've got arguments supporting the profit maximizing hypothesis. Large stockholders held by institutions, banks, the security by professional analysts. So here's another issue is that some people say, no, companies, they actually maximize their profits because all of the managers, they're professional people. They take, good training. They are getting professional mentoring. They have some other bankers behind them or after them. Stock market discipline and competition. If managers do not seek to maximize the profits, then firms will face the threat of takeovers, or maybe they change management. So here we're talking about the importance of, if you don't do a very good job, someone will come and stop you. And then the Obama example was one of the good examples to how this, someone can come and stop. And then there's an incentive effect. The compensation of many executives is very highly tied to the stock price. So many companies now, if you have a manager, you give them salary or you give them a percentage. The idea here is many companies, they make it percentage. This way they have a line, they make sure they don't diverge very high. They're still close. So if the manager at the end of the month, their income is, or their salaries or their bonuses is highly tight with the performance of the company, then they will work for the company, not for anything else.
What's the problem with the short-term performances?
Determinants of discount rate, the risk.
You
You guys remember CAP-M?
investment.
Yeah, time that you're going to get
No, you calculate WACC.
work,
Yes.
yes.
What
The
are
weighted
the
average.
components of that equation?
Yeah, you have beta,
Return of investment.
and you have the interest rate,
The free.
the free interest rates, and you also have the how much debt you have and how much cost of debt you have.
Sir, actually they calculate it differently. So one of the ways is the beta. You can use the other also.
Yeah, you can use beta, you can use alpha.
Alpha. What is the risk rate?
To what?
Risk rate.
Yeah, the risk-free rate is, what is it, 15%?
Central bank, the central bank rate.
15.
It's the central bank rate.
The central bank rate.
Sir, what's the N? I don't understand.
N is the life of the firm in years. How many years the company will stay for in the future? Many companies, they will stay forever. But there are some companies, they don't stay forever. For example, this company will stay for the next. By Yemen law, if you establish a company, it is by law for 25 years. You see? So that's by law. Even though if you do the calculation, probably you will go more. But basically, this kind of give you the equation. They're trying to go back to the equation. Okay? Do you guys remember if you buy a cow? Remember if you buy a cow? How much is this cow worth? If you want to say, how much is the average good cow these days? $300? $300,000. So let's say $2,000. $2,000 or what?
1,200.
Okay, if we say this is a cow is a company, and we want to calculate how much is the value of a cow, you can do, some people will take the cow, how much it weighs, multiply it by the average price of 1 kilo of beef, and after you take some percentage that is going to be, you see, some people will look at it differently. You take a cow, you see how much milk you get it, which is how much dividend or future payments. How much milk you get, how much is the price you sell per milk, how much milk you produce per day, per year, and then the lifetime of the cow. See, the lifetime of the cow becomes important, just like the lifetime of a company is important. And that's going to be the period where you will get this cash flow or this milk that you will gain. Do you guys like the cow example?
Yes.
See, I always thought, there are some students, they prefer the cow example other than the discount rate. And some people prefer tomatoes. Let's see. Next, we've got here the present price. Now, this is the equation. This is the equation you were talking about, right? This is the equation you were talking about.
Yes.
So here it says the price. See, the price of a cow or a stock. You take the first dividend, which is this is the milking way. So how much milk that you will get today, how much milk tomorrow, how much milk after tomorrow, how much milk after n number of days, and you always divide it by the 1 plus k, which is the discount, for the time period. Because remember, I will pay $2,000 today for a cow. Will I get the milk that it's worth today? No. I will get it over a long period of time. So we need to take that period of time into consideration. And you guys remember Al-Marai story? Do you guys remember a story of Al-Marai? See, inside Al-Marai, how many people have heard of the Marai story? Not very many people. Marai story is, inside Al-Marai, the cows there, do you guys know Al-Marai? Anyone have tasted the tazaj? Al-Marai tazaj. Did you try it? It is amazing. It's a milk that you have never tasted, especially if you were born after the Nido generation. Now, the thing about Al-Marai story is that inside Al-Marai, they take care of their cows. And according to Fatih Abdul Wasi Al Said, he said when he visited Al-Marai, the average cow there produces 23 liters per day. And you compare this with the average best Yemeni cow that produces around 7.5 liters per day. So you can see the amount of productivity per cow gives the cow higher value in present value. Because how much cash flow you get in the future, right?
They give the cow oil.
No, they give you sir.
No, they actually...
nutrients or something.
No, actually, the cow in Saudi Arabia, Saudi Arabia is famous for camels.
Yes.
The cow is imported 100%. And if you see, there's a documentary, if you Google the National Geographic on the... And you will see there, it is almost a green heaven inside Saudi Arabia where these cows live. Each cow, they give them like 5 square meter of space. Plus, did you see that water that they spring over people in Al-Hajj? They do the same thing for all of their cows. Do you see? It's a 5-star environment. And these cows, they actually are not Saudi. They're actually coming from the Netherlands, from Australia, New Zealand. So they're actually bringing them and they're trying to adjust the temperature so they can produce. Now, of course, from an economic perspective, if you calculate the price, how much you have to pay to maintain these cows and how much milk you will get, you do the calculation and then you see, is this feasible or it's not feasible, right? And you need to calculate the transaction cost and everything else. And based on that...
A lot. But
Like they're supplying it to 25 million people like...
So if we continue here, this is the price. The firm is assumed to have an indefinitely long life. Price of unit stock earns dividend. This is the equation. You take the price. D is the dividend. You divide it by K is the discount rate minus any growth. How did we reach this equation? It comes from mathematicians. They help us to understand how this can be calculated. A company tries to manage its business, so dividends over time period. Risk incurred, they bring the stream of dividends, always create highest price of the company's stock. And then when stock options are a substantial part of the executive compensation, management objectives will tend to be more aligned with the stockholder objectives. So this is an answer to the agency problem. And now this is the last 2 parts of this chapter, which is the market value added. What is this? Difference between market value and how much capital was paid by investors to the company. So how much? This is an important question. You have a company, you want to sell it. How much did you sell your company?
Market value.
You need to look at the market value. And the market value is how much people are willing to pay compared to how much you actually paid yourself. And that's the market value added. And then the other question here, it says market value. It includes the value of both equity and debt. Capital includes book value. Market value will always be positive because MVA may be positive or negative. And then here we have this EVA, and we said EVA is the economic value added, and it's basically how much return on your total capital minus your cost of capital. And you multiply it by your total capital, you get your economic value added. Either bigger than 1, and that's when shareholders are rising, and -1, shareholders are losing. And economic profit, we talked about economic profit. We said accounting, they do only explicit. Accountants, they only use historical cost, while economics, they don't. They always, not only historical and explicit, but also they do implicit. And they also consider replacement. And they also consider anything else, opportunity cost, and that's and then global implication. That's the summary, and that's